Australia's unemployment rate remained flat at 3.5% in December, with the Bureau of Statistics revising the rate in November up from 3.4%. Australia's economy shed about 15,000 jobs during the month, and the participation rate slipped from a record high of 66.8% in November down to 66.6% in December. Here's the reaction from the Treasurer, Jim Chalmers.
First of all, when it comes to the jobs data, we are really pleased to see the unemployment rate stay around historic lows. 3.5% for December is very welcome news in the context of a slowing global economy. One of our best defences against the uncertainty and the volatility in the global economy is low unemployment, and we have that.
Joining me now is HSBC Chief Economist Paul Bloxham. Paul, thanks so much for your time. Is the jobs market starting to run out of steam?
I think so. I mean, that's my call. The unemployment rate was 3.5%. That's the headline, right? And that's the one you cited. But it's been 3.5% now for 6 months, right? That's the same level it was around June and July of last year. Employment fell in the months. Now, monthly employment's quite volatile, so it's hard to sort of really get a clear read on that. But if you look at other indicators like the job vacancy indicators and the job advertisement indicators, they've all come down. So job vacancies have now fallen for 2 consecutive quarters, in the second quarter last year, the third quarter last year as well. And even things like the wage indicators, if you look at the really timely ones that we have, they accelerated a lot and they've lost a little bit of momentum recently. So look, I think it is reasonable to say that the labour market has passed its peak tightness, or is passing its peak tightness right now. And that from here, the labour market's likely to loosen. That's the feature of what we're likely to see through 2023.
So wages growth, where's that going to be going now that the market is starting to loosen up?
Well, so wages growth has been picking up, but not in a worrisomely excessive way. This is a tricky thing to explain, but wages growth was way too low prior to the pandemic. It was running at rates of close to 2%. And a rate of wages growth that is consistent with the RBA's inflation target, a good rate, one that's sort of reasonable for the economy, a tracking level, is about 4%. And on the last wage price index, we're sitting at 3.1. On the quarterly measures, we're getting up towards that 4. So basically, wages growth has picked up, but it's not picking up in a way that we should be worried about, worried that it's excessive and that it's going to drive too much inflation and so on. So the labour market itself seems to be quite well behaved at the moment in the scheme of things. And a cooling of the labour market is actually something that pretty much the RBA needs to happen anyway, in order to make sure that we don't get too much of a pickup in wages growth or persistently high inflation.
Yeah, the cash rate's at 3.1%. Reserve Bank meets next week. We saw the stock market reaction today to the unemployment numbers. Where do you see the cash rate going?
They meet in early February, so they've still got 2 weeks.
2 weeks,
actually.
7th of Feb.
What's really good about that is it gives us 2 more weeks of data, so for us economists to watch what's going on. Look, I think it's a really close call. I really do. I think that the RBA has got options here. The one option is to say, look, inflation's still too high. It is. And underlying inflation is too high. Next week, we're going to find out again in the inflation print we get that it's still higher than the RBA's target. And so they could lift interest rates further. That's option number one. Option two is to say, look, globally, disinflation is underway and prices are starting to come down. The global economy is slowing very sharply, particularly the US. Overnight, we saw some weak figures. The housing market's cooling. It's clear that monetary policy is having an effect. The local jobs market is starting to wane to a degree as well. And here's the big one. The big one's this, right? The RBA has already lifted its cash rate by 300 basis points. And there's still a lot of the effect of that to flow through to the economy yet, particularly as a lot of these fixed rate mortgages roll off onto the variable rate mortgages and they get this massive reset from 2% rates to closer to 6% rates. So look, the RBA could choose to say, look, we've done a lot already. And actually it would be we can sit still at the moment and just observe how much this global downturn and the inflation momentum loss globally is going to have an effect. On the other hand, they could say, look, inflation's too high and we need to go a bit further. But you can see my leaning is there isn't much more to come. Mm-hmm. Maybe there's one more, maybe not. Maybe they're on hold. And my central case is they're on hold. But, we'll see what the next couple of weeks delivers and how the RBA decides to read all of this.
Let's shift to New Zealand with the Prime Minister Jacinda Ardern announcing a resignation. Is she leaving the New Zealand economy in good shape?
The New Zealand economy, I think, is quite challenged. We're of the view that it's really got quite big issues this year. I mean, one of the key ones, of course, is inflation's picked up. It's picked up in a way that is well above the central bank's target. It is in inflation expectations. It is in the wage setting process. So the RBNZ has had to go hard in terms of lifting interest rates to slow the economy down. We think New Zealand will have to have a recession in order to get that inflation out of the system. And we think that they're ripe for more reform as well. There's an election coming that was announced today as well in October. As we head towards that election, we would hope that policymakers in New Zealand start to really think about the sorts of reform measures that need to be put in place: competition policy reform, trade policy reform, infrastructure, more focus on climate and energy, and those sorts of things that could really get the New Zealand economy going. We talked about New Zealand years ago being a rock star economy, an outperformer in the OECD, and we're hoping that, with a bit of rehabilitation, that rock star will return at some point. But it really does require reform.